Hello everyone, welcome to Commerce Logic. Today we are going to discuss about cost of capital. Now we'll see what is cost of capital here. It is the minimum rate of return required for the investment project. It is also called cut-off rate, hurdle rate and discount rate. The cost of capital is the minimum rate of earnings or the cut-off rate on the capital expenditure. In simple words, cost of capital is nothing but the expenditure we incur for our investment in particular business activities. So, for commencing a business, we require some sort of expenditure. That expenditure can be defined as cost of capital. A firm needs for various capital budgeting proposals. Yes, these funds can be procured from various types of investors. First, debenture holders. For commencing any business, we need some fund. We can procure that fund from various types of investors. Those are first one is debenture holders, and second one preference shareholders, then equity shareholders. Through these many investors we can procure funds and then we can commence our uh, purpose of commencing business. Then the investors have an expectation of minimum return from the investment. So these debenture holders and preference shareholders and equity shareholders have some sort of expectation of incurring return on investment. So for that, the minimum rate of return expected by the investors depend on the risk perception of the investors. So they also invest by studying and deep investigation of the purpose of us. That means for the purpose of what the business is being commenced. Only then they are going to invest their business or their investment in particular investment venture or for some investment purpose. Then factors affect the cost of capital. What are the factors affecting the cost of capital? First one is risk free interest rate. First of all, we are not incurring any interest on that. Then business risk. We are doing business, so we will face business risk. Financial risk. We need some fund. That means we should well prepared of facing the financial risk. Then we'll see now what is risk free interest rate. It is the rate on the government securities and other secured form of investment backed by the government. Business risk. It is related to the response of EBITs to the change in sales revenue. That means business related activities. Financial risk. It is affected by the cost of capital or capital structure or the financial plan of the firm. What affects the cost of capital? We'll see. There is some factor should I affect the cost of capital. Now we'll see. Liquidity and marketability. These are the two things will affect the cost of capital. Next, if the higher liquidity of investment, then the investor expects low return, otherwise expected return is higher. The cost of capital can also be treated as the opportunity cost of the supplier funds. The basic assumption of cost of capital is the business risk of the firm is unaffected by the proposal being evaluated the cost of capital. There is another assumption of financial risk of the firm remains unchanged. Financial risk is remaining unchanged and business risk also is remaining unaffected by the cost of capital. Next, it is classified as follows. First is historical cost, second one is future cost, third one is specific cost, fourth one is composite cost, fifth one is explicit cost, next implicit cost, then average cost and marginal cost. Now we'll see calculation of cost of the capital. Step 1. First we should calculate the cost of specific source of capital, debt or preference capital or equity capital. That means we say cost of debt, cost of preference capital, cost of equity capital. Then we have to calculate weighted average cost of capital. Then it is again cost of debt is again classified into two types, that is irredeemable debt and redeemable debt. Now we'll see what is irredeemable debt. Irredeemable debt is nothing but which is not repaid within a stipulated period of time. That is called irredeemable debt. And now we'll see what is redeemable debt. It is paid within stipulated period of time and this is called as redeemable debt. Now, in irredeemable debt, it is in the form of a formula I of 1 minus T slash P into 100, where KD stands for cost of debt for irredeemable, I stands for interest on debenture, P stands for sales price of debenture, T stands for tax rate. Next, for redeemable debt, this is the formula and you can see the full forms of this alphabets which I have used in this formula. This is example of irredeemable debt. Say 15% perpetual debentures of rupees 1000, so let premium of 10% and tax rate is 35%. So we know the formula for irredeemable debt and we have calculated, we have substituted those things in this formula. Then we have written, we have got 8.86 percentage. Then cost of preference share capital. This is the formula. If we want to use for irredeemable, this one we can use. For redeemable, this one we can. Thank you. In the next video, we'll see continuation of this topic. Thank you. If you like, subscribe my channel.